Welcome, 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 and Grand Rising. This is Monet. I want to welcome you to my YouTube channel. Let's get this Monet. And before we get started, I want to give a disclaimer. This information contained in this lesson is for educational purposes only. No representation is being made that any account will or is likely to achieve profits or losses similar to those discussed in this lesson. The past performance of any trading system or methodologies is not necessarily indicative of future results. By attending, reviewing, or adhering to this lesson, you agree that my company and I are not responsible for the success or failure of your trading account or business or any of your trading affairs. The idea I'm about to represent are ones that I've learned from other professionals or other traders. And I don't proclaim or claim to be the originator of any source that I'm about to, any information that I'm about to share. Okay, so with that being said, we're going to go ahead and get started. So this is week 4, and we're talking about price action. And you want to know what price action is. So to describe price action and what it is, price action is basically the movement of price within a given time frame, right? And also the volume, the momentum, and all of that encompassed on a chart. And when price action happens, it usually comes out in a pattern, whether it's a wedge, a double bottom, a double top, so forth and so forth, so forth and so on. And the candlesticks represents that. So one of my faves is is one of my favorites. Patterns of trading is a double top and the double bottom. But let's get back to what is price action trading and how does it work. Okay. Just to get started, so here the idea, most traders think that price goes up because there are more buyers than sellers. Nope. Here's why. Let's say that are 100 buyers, each wanting to buy one share of Google. At the same time, there's one seller, but the seller wants to sell 1 million shares of Google. Okay? What do you think would happen to price? Would it go up or down? So let's go ahead and go look at Google. So since we're talking about Google, let's go look at that ticker. Hold on, let me log out of my broker so we don't run into any hiccups because it's not going to allow me to trade stock. And Google is a stock. So let's go look at Google. We need to find the stock, Google. Here we go. There goes Google. So, all right, so let's do this again. So let's repeat that. Let's say that there's 100 buyers, right? We have 100 buyers in the market and they want to buy one share of Google, right? At the same time, there's one seller, but the seller wants to sell 1 million shares of Google. What do you think will happen to price? Would it go up or down? For those of you who said it'll go down, that's because selling pressure is greater than buying pressure. You are absolutely correct. So what you have to understand is price action is about supply and demand, okay? That is going to be formed on the chart. So with that being said, this has nothing to do with there being more buyers than sellers, because in this case, there are more buyers than sellers, but the price is still going down because the seller pressure is greater, meaning the shares, you have one seller, but his volume, right? The seller's volume is 1 million. Buyers, there's more buyers, but their volume is 1. They're only getting the quantity of one share each only gives buyers 100 shares of Google. Okay. And this is what price action trading is all about, understanding the imbalance between buying and selling pressure so you can better time your entries and exits and improve your trading results. Okay? So we're going to write that. We're going to do a call out. So let me go grab a call out and we're going to type that. So let's go get a call out and we're going to write price action. Okay? So let's do that. So price action week 4. Okay. What is price action? It is understanding, the price action is understanding the imbalance between buying and selling pressure. Okay. That's what I'm going to say price action is. Okay. Price action is understanding the imbalance between buying and selling pressure within a financial market. And the example of a financial market could be Forex, crypto, or stock market, or stock. Okay. So there we go. There goes our call out. That is what price action is. And let me bring this a little down a little so we can actually see it. Okay. All right. So now let's get into some more. Okay. So what are the benefits of price action trading? You can ignore fundamental news because price is all you need. Okay. So that's another thing. So let me go put that out. Let me get a text box so we can write right. So what are the benefits? What are the benefits of price action trading? One, you can ignore fundamental. So that's news. Fundamental news because price is all you need. Okay. So price is all you need to focus on. Two, unlike technical or trading indicators, the price is the price. My typing skills are getting horrible. But that's okay, guys. We're going to focus. 3, you can have, you have a framework to trade in different, I'm trying to word this correctly so you guys can get the thought. It says you have, let me see. What I want to say is basically, you have a framework to trade in different market conditions. Oh, that's perfect. You have a framework to trade in different market conditions. There we go. That's what I want to say. Just had to get my thoughts together. Okay. Okay. Now that I've said that about price action, right? Now we need to, let me move this over here so you guys have it. You got the definition of price actions, the benefits of trading price actions. Now, let me explain my theory, my ideology, and be methodical about this so I can put this in perspective for you. You can ignore fundamental news because price is all you need. That's number one, right? Now you might be thinking, but Monet, fundamentals are what drives the market. How can I ignore the news? Let me ask you this. Have you ever noticed how the market goes down when there's bad news and goes up when there's good news? Here's an example. Google stock had a negative earning in 2014, 2015, and 2016, but the stock price still gained 700% in 12 months. If you were trading based on the news, you probably got burned and missed the monster rally. Now, when we talk about rally, we're talking more about supply and demand with price movement. Follow me as we're talking about stocks and understand we'll get into supply and demand at a later date and time. So just stay with me. Okay. But let's getting back to that. So if individuals were trading based on what the news was back in those 3 years, you missed and blew your account, or you got burned because you missed the monster rally, meaning that price still skyrocketed 700%. The stock went up 700%. But those of us who just traded price action, price is the price, and we caught that rally all the way up. We caught that bull run. But what if you ignored the news and just followed price? How would that turn out? That would have turned out great because we would have got 700% return on our investment, right? Have you ever wondered how financial news always has a reason for the market's ups and downs? It's because they have a slew of positive and negative news on standby. If the market is up, they choose to share the positive news. And if the market is down, they focus on the negative news. Now, that's why there's always positive and negative fundamental news floating around, and the type of news that is shared is dictated by the price movement, not uh, excuse me. Goodness, I'm choking on my own tongue here. Not the other way around. Okay? So we got to think about that. Have you ever heard a news reporter say, "I have no idea why the market went down or went up today"? Absolutely not. Now, so let's look at this. Price gives you an objective view of market without manipulation. Most trading indicators work by applying a formula to the price. For example, a 200-day moving average calculates the average closing price over the last 200 days. Now, there's nothing wrong with using indicators in your trading, provided you understand how they work. But if you don't, you will be manipulated by trading indicators. Let's give you an example. The relative strength index, the RSI, right? The relative strength index, also known as the RSI, indicator shows oversold on a daily time frame. But if you adjust the setting, you can change the RSI to overbought. That's because the RSI calculates the average gains to losses over a fixed number of periods, meaning daily, right? And if you adjust the number of periods, you'll get a different RSI reading. So with setting, so which settings to what settings do you trust? I'm trying to get my words out. I'm fumbling over my words. I'm excited. So, what settings do you trust? The overbought or the oversold RSI? And there lies the problem. If you're not careful, you can manipulate indicators to fit your bias, and that's a recipe for disaster. So, let me give you a visual. We go and get our indicator, right? We go and get our RSI. So, we get the relative strength index. Now we have it set up. So let me set it up in a way that we can understand. My RSI is red, my moving average is yellow, right? My upper Bollinger Bands, I'm going to make red because I know that's when I want to get into a sell. My lower Bollinger Bands, I'm going to leave green. Now my RSI upper bands, I'm going to make this I'm going to make this a darker red, and I'm going to make this a lighter red so we can see. And then my middle band, I'm going to make white because it's neutral. Bashata. Yep. And then I'm going to make my lower band, I'm going to make that a darker green so I can see it, right? And then for my background, we're going to make this a little lighter so we can see everything that's going on. Now, we have the 70 and the 30. Usually no, that's the oscillator. Okay, so now we have the 70 point, we have the 30 point. Now we have the moving. Let me make sure I got the right moving average because I wanted an EMA. I want an exponential moving average. So let me go to put, and we got it on a 14 days, but we're going to make this, we talked about the 200-day, right? Then the type of we want is an EMA, and the length we're going to do is 200. And then the Bollinger Bands standard deviation, we're going to leave at a 2, right? So why don't we talk about this? We'll say 100-day. Okay, so now we see that this is our what? The yellow is our moving average. So anything above we know is going to be a what? A buy. Anything below is going to be a sell. So we know that this is acting like a floor. So right now we are what? We're overbought. So we need to get ready for a sell. And then when we come down here and being oversold, we need to get ready for a buy. Okay. Now we have that displayed for you. Now, what about price action? Well, the price is the price, and what you can see is what you get. No formulas, no adjustments, and less manipulation. I'm going to say that again. When you have an indicator, can you trust the settings? What settings do you trust? So if we set this up and you notice that I changed, did you see when I changed? The default was 14 days. So let's go back. So if I put it back to 14 days, right? Do you see how it changes? Now, if I put it on 50 days, do you see how it changes? So when you change the fixed number of period, or you change the amount of length of days that the indicator is calculating or putting into the formula, if you're not careful, you can manipulate indicators to fit your bias, and that is going to be the recipe for disaster. Now, what about price action? Well, price is price, period. And what you see is what you get. There's no formulas, there's no adjustment, and there's absolutely no manipulation. If I say less manipulation, because in less liquid markets, the price can still be manipulated by those with deeper pockets. So you have market movers. They manipulate the market, such as if we're talking about the Forex market, central banks drive the market, right? You have big commercial banks that drive the market. You have market movers. They would be considered a market mover. Now, when we're talking about stock, you have news that manipulates the market, that does that, right? And then you have big companies, hedge fund companies that are coming in investing in these stocks. And when they do, they may take the stock a different way. They may dump a whole bunch of stock into the market and sellers are in the move, or they may have a lot of supply to meet the demand, and then you have a whole bunch of buyers. So with that being said, just know that this is how price action works. Price action works based on what? Imbalance between buying and selling pressure within a financial market. So I look forward to talking with you at another later date and time. So join the next video so we can